Can we fight inflation without risking financial stability?
Well, I think we have to first look at where we are and just how sharp our tools are to be able to achieve that. We spent the better part of a decade and a half doing continuous rescuing of the economy at the slightest sign of pain. And that was not just monetary policy, it was fiscal policy as well. And we had continued monetary easing, continued reduction in interest rates, as well as continued highly stimulative Treasury policy. So it's not surprising that with all the many regional banks out there, that some of them would make use of those rules to try to get a little bit further ahead by maybe being able to offer better rates to their depositors or better returns to their shareholders by moving out further on the yield curve, because we had a positively sloping yield curve and short rates were just so ridiculously low, largely because of all of this work of the Fed. And then we stepped on the gas and went all in at exactly the time we probably should have been steering back to the middle of the channel. And the result was that the Fed woke up one day and saw what I think many others had already seen, which was that inflation was not going to be a very easy thing to deal with and wasn't just going to pass through the system so rapidly. And the course change was so sudden, we raised rates to very high rates very quickly. And that's somewhat of a blunt instrument. But all of a sudden it exposed some of the behaviors of some of those regional banks that maybe got over their skis and were a little more self-confident about the direction of the world. And the problem is that exposes a real potential for contagion in an industry that is somewhat systematically important for our economy.
So the Fed has said they want to get to 2% inflation. We're a long way from that still. Come down some, long way from that. Can we get to 2% without doing real damage to the economy?
In 2008, I was told by one of the Federal Reserve governors that we ran unemployment up to 10%, and all we did was take out 50 basis points from inflation. There's no magic to 2%. Why not 2.05? Why not 3.02? Why not 3.15? It's going to be very difficult to do that. The tools have also been blunted. And what I mean by that is the Fed owns so many securities itself that a lot of the negative impact is on its own balance sheet as opposed to getting to the economy. And rather than have differential effects on specific industries, I think to some extent the Fed wants to fight inflation by getting you and me and others to cut back our spending, to cut back our hiring, and to do other things, which is why there's all of this job owning. The Fed knows that interest rates are only one tool. And inflation, by the way, was not just the Fed's fault, even though we can look back and say, wow, they sure were easing for far too long. But doesn't the Treasury have a role in this? And therefore, shouldn't they have a role in curing it as well? There's unspent federal money all over the place in this country that's going to continue to fuel inflation. And when we take all the debt off consumers' balance sheets and we put it on the federal government's balance sheet, we produce consumers who can keep spending. So we've created quite a conundrum for ourselves by interfering, in my opinion, a bit too much with what that natural rate of inflation should be. And the last point I'd add is we spent the better part of 15 years trying to make inflation 2% when it seemed like it wanted to be a little lower than that. And we couldn't get it up to 2%. Now, all of a sudden, the collective work that we've done over the last 15 years has created an equation that's made it feel like it's a lot higher and like it's not going to be so easy to bring it down.
Well, we got a taste of some collateral damage this week. We're not sure we're done even in the banking sector, but you know credit particularly well, and they say that credit sees things before equity picks up on them. As you look out there from a credit perspective, where should we be looking for the possible next piece of collateral damage?
I think there are two parallel universes of collateral damage, and we're going to see it in both of them simultaneously for the same reason. Low rates drove private equity types of buyers to buy things at high prices and finance them with low-cost debt. That's true in real estate, and it's true in the corporate world, and we're going to see it in both of those universes. In real estate, we don't know what the price for the market clearing price is, or cap rate, for high-quality real estate. The first thing that gets exposed, of course, is the low-quality real estate, the B office building that's obsolete, that really can't be converted into anything useful. But if you take high-quality multifamily, and there's something like 800,000 or 1 million units under construction right now that are financed through construction, when they wake up and the building's done and it's stabilized, it's a very high-quality asset. I think you'll find that many sponsors, whether they're private equity firms, whether they're REITs, or whether they're individuals or syndicated partnerships, will get far less debt proceeds for refinancing those properties because the interest rate is so much higher. And then we'll see some of those will hit the wall, some of the equity holders will put in more equity, and others will have some kind of a different type of reckoning. The second area is corporate, and you see exactly the same thing. High quality corporate borrowers that maybe haven't hit the wall yet, the economy's recovering, things are pretty good, but demand's coming down a bit. They have balance sheets that are not infinite. They financed at a certain multiple of EBITDA that crept up from 4 times to 5 times to 7 times. And when they refinance and they have to finance at 11% cap rates, 11% interest rates, they'll have no excess cash flow. And on top of it, their trajectory was interrupted by a revenue interruption called COVID. So the result, I think, will be situations where sponsors either have to put in more capital, or they have to kick the can down the road, or they have to restructure.
So 2 areas, real estate you mentioned, as well as corporate. What opportunities do you expect may come Canyon Partners' way, for that matter, from those?
The first opportunity is almost as much technical as fundamental, which is that the quick reversal of rates caused mutual funds, who are daily liquidity funds, basically to suffer from redemptions. We had about $750 billion come out of fixed income mutual funds, some investment grade, some non-investment grade. And when a non-investment grade bond fund has to sell a bond very quickly, they're selling into a world that's not perfectly liquid. So some of the price discovery on things that have been sold has been at prices that are really pretty shockingly low. So that's sort of the first phase. The second phase, we see that in securitized product, where people have taken things like home improvement loans or car loans or consumer loans and put them into securitized packages with rated debt. The price reduction in a lot of those securities has been quite dramatic, even in CLO tranches. I think the next thing you'll do is you'll start to see some restructurings. In the weaker companies first, they may be the ones that we pass on, but there are others that are very strong companies that simply have an inappropriate balance sheet. In the same way, a strong multifamily property in a growth market that was purchased for a 3.5 cap rate also might have an inappropriate balance sheet for the long run.